Hey, what's up, everybody? Welcome back to Investing Sucks. So, today we're doing another video where we're going to look at an investment thesis that was posted on the website Value Investors Club. So, this is a series where I showcase to you guys different ways to approach the whole research process when it comes to investing and try to show you guys what I think actual good due diligence looks like. And, like I've said many times before, Value Investors Club is a great place to go and to learn and get better at investing and to also help you generate ideas. It's completely free to use, and they have really unlimited amounts of articles that you can look at. And the people that post on this site do actually have to go through a vetting process. So what you're reading isn't coming from just some random armchair analyst out there. It's usually people that at least know a little bit about what they're talking about. And today we're looking at Crocs. So this is one that was posted actually about 9 months ago. It was in the middle of June of 2022. And I chose one from the past because I wanted to pick one where there was actually a bit of time to see how their thesis played out. So then we can look back and see if they were right about things. And then, was the article actually worthwhile reading at that point? And I also thought this write up was a really good example of how you can find a really good investment idea without having some deep industry expertise or some very technical knowledge about some industry. And sometimes all you have to do is you just need to pay attention to things and not be afraid to go against the consensus view. And you can have pretty great results doing that. And as you'll see, this style of investing that's exhibited throughout this article is pretty similar to my own personal style, which I've showcased in numerous videos on this channel now. And it's a great example of, just understanding why a company is valued the way it is, understanding why that view is probably incorrect, and then taking advantage of it. So what we're going to do is we'll go through the article, we'll identify the main points, the important points that was made, and then we'll see how things actually ended up playing out. So there's a few different parts. It's a rather short article. I'll probably skip this whole company history part because I'm sure everyone knows who Crocs is and what they do. I mean, they sell those rubber shoes. One important point to note about Crocs, though, is this was in early 2022. They made a very significant acquisition of a company called Hey Dude. So this was a $2.5 billion acquisition. And to put this into perspective, Crocs, as of today, is about a $7.3 billion company. Now that's changed a lot, as we can see over the past 2 years. It's fluctuated very significantly, but this was a rather significant acquisition. And later on, we'll get into what this acquisition actually means and what the significance of it was. So let's actually add some context to Crocs at this point, because the person's main points here, they give like a quick pitch, and what they're saying here is Crocs is a name that many investors will not touch right now, regardless of valuation, for two reasons. So one, it's a consumer discretionary business which investors want to avoid as we enter a inflation-driven recession. Like other consumer discretionary businesses, it was a massive, stimulus, stay-at-home beneficiary of 2021. The EPS is on a backwards looking basis is looking extremely cheap, and the consensus estimates show strong continued growth, which may be too optimistic, and no one wants to buy into negative revisions if those growth prospects end up getting revised down. And then they also say many view Crocs as a fad product, which make it uninvestable for them. So I think the whole idea of them being a fad, I can kind of agree with that, but at the same time not agree with that, because as they're going to show in this video, Crocs is a company that has had very, very strong unit sales volume growth throughout its whole history. So it's got about a 20-year company history. And what they point out in this article right here, where they address is it a fad, is that there were only 2 years where their unit volumes declined, which is in 2008 and 2016. Now, what I want to do here is go to the charts, and we can look at the revenue. So this is revenue for each quarter. And what we can see is it was, very, very consistent for this time here, not really a lot of growth, and it actually started coming down. And we can see pretty much the exact same pattern repeating every quarter where, in the first quarter, you have relatively lower sales, then sales pick up probably going into the summer years or the summer months. And then during summer, the sales are the highest. And then during the holiday season, they kind of level off a bit more. But then this whole pattern got, completely obliterated as we moved into, these abnormal years, which have been the last 3 years. So now I would say it still does kind of strike me as a fad company, because if someone were to come to me, 10 years in the future and tell me that Crocs no longer exist, I wouldn't exactly be surprised, right? Because consumer tastes are constantly shifting. And with a company like this, you're really investing in their brand, right? Because at this point, with a company has a 20-year history, there's a big element of the brand there, and the fact that they haven't gone away yet may signify that they have staying power with their brand. And what they can do is in the future, they can continue to make acquisitions, expand their portfolio and turn Crocs into a conglomerate rather than just, the company that sells, one type of shoe. Now, the other point that he made here, uh, so it's a consumer discretionary business. So this was in, like you said, this was in June of 2022. So what was their, what kind of a PE ratio were we looking at that point? Because this is going to tell us, what the business was valued like at this point. So around here, they had about a 5 price to earnings ratio, which came down significantly from about a 15 price to earnings ratio at the beginning of the year. So from 15 down to 5 in a span of about 6 months. So clearly a very, very strong negative revision there. And this is gonna be a bit of a spoilers, but if we look at the stock chart to see how things actually ended up playing out, we can see if we would have invested in Crocs when this article was released, we would have had amazingly strong returns because it was released about this point, so about $50 a share. It's now at $120 a share. So that's, over 100% plus return in less than a year. So obviously, we should pay attention to what this person's saying because they were probably at least a little bit right about their thesis. But look at this very strong revision down from what it was before. In fact, if we look at the 5 years, so it bottomed, in March of 2020, which we all know what was going on at that point, at, $11, $10 a share, and then shot up all the way to $180 a share, at like the beginning of 2022. And then as the fears of the recession, all that kind of kick in, it starts to decrease substantially. And then at this point is when this article was released. So I do think these points that they were making here were very true. And it's a pretty simple reason overall, right? Just that there's probably a little bit too much fear baked into this stock price, and I do think that it's a brand that has staying power. And I was kind of curious to look at this a little bit more. And so what I wanted to do, and I've showed this tool before, and it's a pretty cool tool to use when you're looking at a company like Crocs, something that is something that people would Google online and kind of learn about and has interest that moves around a lot. And so this is the interest in terms of like Google searches and like trends on Google searches. And this is going back to January 1st of 2004. And what we can see, it's almost ominous how their chart here lines up with what we were seeing before with their revenue. So I'll pull this up again. Their revenue on a quarter by quarter basis, we can see it's pretty much moving exactly in tandem with the trends here. So this is almost like, real-time data about what Crocs' revenue will look like. As we can see, it follows the same fluctuation pattern, and then 2020 happens, and then it kind of diverges a bit more, but it still does show that, upward trend there. Okay, so let's go back to the article and let's read this section here about why the business spiked in 2021 and then why the stock subsequently crashed after that. So what you're going to see here is it's a great example of an analysis that is very sound, very solid, but not too deep and not too technical, right? But really just enough so you can understand what's going on. So they're saying Crocs was clearly a lockdown beneficiary, but as alluded to in the prior post, Andrew Reeves, who became CEO in 2017, deserves a lot of credit for improving the business. While sales and volumes showed decent and steady growth from 2018 to 2017, and this is kind of what we saw when we were looking at this revenue chart here. It was things kind of seemed like they were stagnating a bit, and the business needed a bit of a change. And we can also see this very much reflected in the stock price going back 10 years, where it was kind of on a downward trend, right? So they needed someone to step in and try to revitalize the business. So they're saying he added some much needed discipline and focus. Sales in the Americas, previously in decline from 2012, experienced a resurgence starting in 2018, predominantly due to targeted marketing and celebrity and brand collaboration. So this person has probably been following Crocs for quite some time, and this is like the benefit that you get when you're following a company for a longer period of time, and you can kind of see the natural progression. You can understand them a bit better as opposed to trying to just, learn everything about the company all at once. So in my opinion, it does help to, even if you're not going to invest in a company right now, to have a company that you're following for a longer period of time. You're staying up to date with recent developments that's going on with them, so that, if there is a sudden fluctuation in their price, you can make a quick assessment as to whether or not that actually makes sense, as is the case here. So sales in the Americas grew 33% from 480 million to 641 million from 2017 to 2019. And then he makes this point about how he sees the younger demographics adopting the brand more due to comfort and individuality. I mean, personally, I don't really like these points because these are just anecdotal and you can't really have any actual data to support it. And I wouldn't really build an investment thesis off of a point like this. But he does state that it's purely observational, but that type of stuff I would usually ignore. And then they're saying the business exploded in the back half of 2020 and the full year of 2021. So sales went from 1.2 billion in 2019 to 2.3 billion in 2021. So almost double in 2 years for a company that was previously, basically stagnating. So that's obviously a huge development in that business. And more importantly, net income went from 120 million to 725 million. So obviously a substantial jump there. And this explains the stock price performance. This is why it went, what seems like unreasonably high at that point. But when you consider, such a drastic change and such a drastic turnaround in the business, which you can see if we look at the financial statements here and, the yearly view, for a long time, their sales weren't really moving, right? We can see 1.2 billion, 1.2, 1.1, 1 billion, 1 billion, 1.1 billion, and then 1.2 billion, and all of a sudden sales just double, and even in 2022 were extremely strong. So it kind of makes sense why we see this movement here. I mean, clearly, if you look at the year over year for sales at this point, it was looking very strong. And if you project that trend out into the future, you have a substantially more valuable business. But those expectations were significantly revised down, as we can see here, as the whole, recession and fears about the, slowing down of the economy kicked in. So that's kind of what happened here. But then you also couple that with the acquisition, which we talked about before. So it was a $2.5 billion acquisition of another shoe company called Hey Dude, and it wasn't received well by shareholders. They're saying here the stock was down 12% on the day of the announcement and has been declining ever since. So that was kind of just added, momentum to that. And people probably didn't like, or investors probably didn't like, the high price that was being paid for this company, because what we can see down here is HeyDude did 570 million in revenues in 2021. So you're paying about 5 times the revenue for, a shoe company, which that seems rather aggressive, right? Even if it is high growth, that seems aggressive. But they do state that Hey Dude was, not just any normal company, it was extremely high growth, growing, 100% year over year. So that valuation could easily be justified. And what we're going to see in this next part here, where we talk about management, is that, or the valuation, which ties into management's guidance, is that they believe that that was a very good price for a very fast growing business. So let's dive into this valuation part now, because this is where things start to get interesting. So Crocs' current valuation relative to management's 5-year guidance, so management, released their guidance on what they think they're going to earn in the future, might be the widest disparity that I've ever seen. So again, this is an example of just following a company. You see they release this guidance. Say you value the company based on that guidance, and you're probably thinking this company is drastically undervalued based on that. But what they do say is that in their experience, I don't know what their experience is, but in their experience, management has more credit, or the market has more credibility than management. And this I would kind of agree with, because management, although they do know their business better than any investor or better than any analyst out there, they're just one player in the entire ecosystem, right? And when you're looking at what makes up a company's valuation, it's millions and millions of investors making decisions based on the information that they have. So you're collectively going against the cumulative information that all the investing public has out there. And management's just one actor in that. Now, what you would expect to see here is if management actually does believe their expectations and it's valued the way it is, they would probably be buying this stock very heavily, because if they actually believe their expectations, they think they're going to hit the targets, they're saying our stock is just egregiously undervalued. So let's take a look at what that actually ended up looking like. So if we go to the insiders tab here, we can see insider transactions. You know, it lays it out kind of in a nice table format here. And what we end up seeing is almost comical, in my opinion, because if we go down to here, so what we're looking at here, so this is early 2022. So this is when the stock price had dropped a lot and it was still kind of dropping. We see all these purchases of securities from insiders. So all of this here from I guess this is early March of 2022 until May 25th of 2022. We're seeing all these, significant purchases of securities, all these here. And then what happens is a complete reversal. Once we get to, the later half of 2022, it's just sales of securities, right? And we can look at the unit prices here, $130 a share, 125, 120, 110. So it went from management completely aggressively buying the stock to just aggressively selling the stock, right? And almost a complete reversal as, the stock price obviously changed. So, I mean, that really shows you management's true colors and what they think the stock is worth. Obviously, they had carried some weight into their expectations, but the fact that there was a lot of selling going on kind of makes me think that they didn't entirely believe it. Now, obviously, people can sell a stock for many reasons. You don't always know what the reason is. But when it comes to buying a stock, there's only one reason, and that's because they think it's going to go up. So let's read a bit into this valuation part because again, it's a super simple analysis, but I think it's, almost brilliantly simple and it does, show you that sometimes in plain sight there are, very attractive investing opportunities out there. You just have to be willing to go against the grain. So the company's guidance was 5 billion in revenue just for Crocs by 2026 and 1 billion plus of revenue for Hey Dude by 2024 with an EBIT margin, so an operating margin of 26%. And their current operating margin, we can take a look at what it is in the financials here. I do think that they are expecting some expansion in the operating margin from that. So a slight expansion. We can see right here it's about just under 24% in their full year of 2022. And they're saying it's going to go up to 26%. Now, you may be saying, Eric, that's only 2 percentage points. How much, of a difference is that really? It's actually quite a lot. Changes in operating margins can really, really influence what a company is worth, especially when you're, doing a financial model and you're trying to project it in the future. So Hey Dude, they said it did 570 million in revenue in 2021. So this represents 21% compounded annual growth for those years. So that's quite strong, especially for a shoe company. So they clearly have high expectations for this. And then they say even dropping this revenue growth down to 8% for 2025 and 2026 gets us to 1.2 billion of revenue for Hey Dude and total revenues for the company of 6.2 billion. And then 26% gets us to, or a 26% operating margin gets us to 1.6 billion of operating profit. And then they're talking about cash flow generation. So cash flow generation for these 5 years will repay the debt and leave the company with greater than $1.5 billion in cash. So that's another interesting observation because you're actually looking at what they can do with that money, not just the fact that they're generating it, but how they can de-risk the company by, paying down their debt. Now, some interest will be generated on this cash, which they will ignore. And they say in reality, the company will stop repaying debt once leverage is below 2 times, and then they'll use the free cash flow to repurchase shares. So maybe that's something that the company has said that they're going to do. And then if they're taxed at 25%, this results in $1.2 billion of net income, which is $20 per share on the current share count. And if they're trading at a 15 times, PE multiple, that makes it a $300 stock. And currently, that's still significant upside from where it is now, which is $125. And keep in mind, this article was written around this point when they were $50. So they're basically projecting, a 6x move in this stock based on, what management has guided as their expectations. But it is interesting to see all that selling from management because they must believe some of those guidance that they released. I mean, perhaps they've revised it down now that they've learned more about the recession, but it still seems like a very large disparity. And then I'm going to skip these paragraphs here and just kind of summarize it quickly. But basically, what they're saying is they're talking about the company's growth prospects. So they're talking about the Hey Dude acquisition and saying it still has some room to grow with the help of Crocs' retail presence, and also it can expand its reach both within the US and internationally, so it can just grow as a company overall. And this kind of just helps add rigor to the thesis, right? And they also say that Crocs itself can grow with their sandals product line, and then also they can expand into China, which China is only about 5% of their business, and they think that it can be more. Of course, that is a little bit risky because you don't have a full sense of what consumer tastes are going to be like in China, and consumer tastes are extremely fickle, right? That's really the number one risk for this company overall is what happens if consumer tastes change, or what happens if there's some new shoe that gets released that suddenly people don't care about Crocs, right? How strong is the Crocs brand really? But having some, legitimate reasons here about why you think it's possible for sales to increase, it does help with your thesis. Because remember, at this point, the company was basically priced for, a decline, right? Or to revert back to what it was before. But if you're saying, I think the business has changed, even if it's, not the massive growth that they saw in 2020 and 2021, I still think that the business has changed for the better. So, and then this part here, they're looking at the actual numbers. So this kind of ties into this is like their expectations. So not really what management's guidance was, but what they think is reasonable given their own personal analysis for sales and whatnot. So this part here, they think that well, one thing they do here is they say they think revenue will grow at 6.7% going forward. That's what they projected because that's what it grew at in the past, which, I mean, I've talked about this before. I don't really like just taking historical, revenue growth and just projecting it into the future unless you're just doing it to try and get a sense of what a business is worth. But if you're trying to actually build what you think are realistic assumptions, then you can't do that because it's unlikely to happen. Things are going to change in this business and you need to account for that. And really, the basis of this whole thesis was simple. There was just too much fear baked into the stock price. Management's guidance was significantly higher than what the market thinks was going to happen. So even if management gets within the ballpark of their estimates, then Crocs is undervalued. And this is, in a way, it's a pretty similar thesis to what I've talked about in a few videos now, like in my last video I did on Sleep Country, where I showed that they're currently priced as if they're a declining business. So if they prove to be anything but a declining business, then they're probably going to do pretty well. Now, Sleep Country is a bit different because they sell big ticket items like mattresses at lower volumes, which are much more of a necessity versus Crocs are a bit more of a novelty, not really a necessity at a much lower price point with higher volume. And also another key difference is Sleep Country doesn't actually give any guidance in their business. So that's a very important difference. But they're undervalued for really the same reason, which is investors think that discretionary spending is going to suffer during a recession. So there's a lot of uncertainty and they kind of just want to avoid it. So that summarizes the thesis. Now, the last thing I want to do is actually look at what their stock price is like today. So obviously this person's done quite well in their investment, having seen it grow over 100% in less than a year. But what are they doing now? What are they thinking now? Do they still believe, all these assumptions? So let's do a quick, analysis of Crocs here. So I'm going to pull up my DCF tool, which is in my website here called tickernomics.com, which I'll leave a link in the description of this website for those that want to find out and just, test it out. But what I'm going to do is value Crocs given management's guidance, right? So I already kind of did the math, so I know what numbers I need to put in. We'll do a 4-year analysis since they said, into 2020, they gave guidance into 2026, so we'll just do a 4-year analysis. And they said 7.2 billion revenue by that time is what they expected. Back then, maybe they've changed their estimates since then, but based on those estimates, we'll see what it turns out as. So that means we need 18% revenue growth, and they said 26% operating margin. Now the tax rate was said in articles about 22% as a cash tax rate. The capital expenditures, I'll just revise these up a little bit just to, account for the fact that they're a larger business now, so they're probably going to have more capital expenditures. Working capital, I'll just adjust this to 0, and then I'll leave everything else the same. And their cost of capital is just under 10%, so we can leave it at that 9.76%, and then we'll use a 10 terminal value multiple. So we hit calculate DCF, and what we can see is they are still quite undervalued at this point. They're not quite a $300 stock, like the author said, but based on those assumptions, they're worth about $200. and they're currently trading about $125. Now, for me personally, I like to see intrinsic value be at least double of the current price in order to have that margin of safety and feel confident investing in them. So let's see what we need to change our estimates to actually hit that point, right? For example, let's say we take this and we project it out 6 years instead of 4 years. How does that change things? Pretty significantly, because now we're saying that 18% revenue growth is going to continue into the future, and they're going to be doing about $10 billion in revenue by 2029. So that is very significant growth, especially for a company that, as we saw when we looked at like the financials, they had stagnant revenue growth for a very long time, just growing at this clip here of, not even matching inflation really, actually negative, but then suddenly things change. So there's a lot of uncertainty you can see with this business, right? And maybe they take the direction where Crocs becomes a true conglomerate and they make all these acquisitions, these amazing acquisitions, expand their portfolio, economies of scale, and all that good stuff. And they turn into, a massive company in the future. Or they revert back to the mean, which is what we were seeing in all these years here. And maybe in 10 years, people don't even care about Crocs anymore and the business starts to fail. So this is a company where it's just so hard to tell what's going to happen. You have such a wide range of potential outcomes that, this is where, if you're an investor, this is where you're going to thrive, right? Because these are the types of companies where if you are able to build up accurate assumptions, then you can do very well by investing in those assumptions, again, if they end up being true. So anyways, guys, that pretty much does it for this video. So I hope you did find this useful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.